Hey everyone, I am really excited for this video today. For any of you guys that are new to this channel, every single week I put out a video talking about the markets, my current investments, and potential investments that I'm looking at. So if that's interesting to you guys, definitely stick around. This week I am going to be sharing about my biggest holding in my portfolio, Alibaba, and why I think Alibaba is the hidden gem of AI stocks. And I'm going to be illustrating this using the history and story around the gold rush in the US. And you guys are going to see the similarities between that time period and now, and what I think is playing out, and why I think Alibaba is in the incredible position that it is. In 1948, a life-changing discovery was made at Sutter's Mill in California: gold. That news spread like absolute wildfire across the United States, igniting a feverish rush of over 300,000 people, prospectors flocking to California in 1849. And that historic migration led to the legendary name that you guys are probably familiar with, the 49ers. Yet despite so many people flocking over there in dreams of striking it rich, very few people actually found their fortunes buried in those streams and hills in the form of gold. But there were others who did prosper, and they weren't the ones panning for gold. They were the entrepreneurs selling the essential tools of the trade: the picks, the shovels, the food, and the clothing. If you guys have been around investing for a while, you guys might already be understanding where I am going with this. And you guys can see in this obviously very grainy photo, you can see every single one of these people here, they're holding a tool of some kind, whether it is a shovel, whether it's a pan. They've got equipment and things that they're using to find gold. So let's fast forward today, and we're witnessing a modern day gold rush. The treasure: artificial intelligence. Companies literally everywhere are racing to build their own AI models, with new large language models, LLMs, appearing at every turn. However, crafting those AI models requires immense computer power and data storage, resources that are neither cheap nor easy to set up. If these companies were to do it on their own, for some of them, it might literally cost billions, which they do not have. Enter the tech giants: Nvidia, Microsoft, Amazon, and Google. Just like the merchants of the gold rush, these companies are supplying the critical infrastructure needed to support this AI boom. And over the past 3 years, we watched as their cloud revenue skyrocketed. The parallels are striking. Those who provide the picks and shovels of the digital age are the ones reaping the reward, while the prospectors of AI and data scramble to find their own nuggets of success. So look at it this way: Nvidia, Microsoft, Amazon, and Google absolutely 100% know they can make a whole lot of money here. They have it set in stone. Their people are coming and buying their computing and storage abilities. Whereas these AI companies are certainly looking at a big shiny treasure, just like the people were when they were flocking to California, but it's really unsure what's actually going to happen. So you can see why it's such a better position to be like the people selling the picks, the shovels, the clothing, the food, or like Nvidia, Microsoft, Amazon, and Google, and why they have absolutely been exploding. You guys can see that the revenue just between these big three and their quarterly cloud revenue has grown from around $10 billion in Q1 2019 to now over $50 billion in quarterly revenue in the end of 2023. If you're looking for a way to take advantage of this modern AI and cloud movement, I believe one of the best places to look right now is China. And the reason I believe that is, first off, China companies are trading at incredibly cheap valuations when compared to the US. And second, China generally is a few years behind the US when it comes to integrating technology into their society. So you're looking back and seeing they could be experiencing the same wave of cloud growth that we have here, and their historically low valuations. And this puts them in a fantastic position when you're trying to look for opportunities in AI. So when we look in China, the largest cloud provider by far is Alibaba, commanding about 40% of the market share, more than double that of its closest competitor. But more impressively, Alibaba serves over 80% of Chinese tech companies and supports more than 50% of all the AI language models in China. This dominance creates a powerful ecosystem where the cost of switching cloud providers is significantly higher than choosing brand of pick during the gold rush. Just like Apple has always done, created a walled garden, much less so will be the case when companies, AI companies, large language models, choose where to put their data and who they want to use for this computer processing power. It's the same thing going on. When you look at what's going on in mainland China, you can see that Alibaba has a 39% market share, and the next closest is Huawei Cloud at 19%. So they sit at more than double. And as Alibaba continues to deepen its cloud capabilities and expand its market share, the tech and AI companies using their services will find themselves increasingly entrenched in an ecosystem that's hard to escape. Like I was just saying, this creates a much less extreme but similarly effective version of the walled garden that Apple has famously built. On top of this, Alibaba has been aggressively slashing its cloud costs to capture even more market share. They're offering cloud credits to AI startups, effectively locking them into their cloud system. And in exchange for these credits, Alibaba secures a permanent equity position in these companies. This means that if an AI startup from China revolutionizes the world, Alibaba will stand to benefit immensely. This is one of my favorite parts about what Alibaba is doing right now. Not only are they selling the picks and shovels, but they say to a few select AI companies that they feel have promise, we will give you the picks and shovels for free for a time until you break a few and you need to come back. You still need to buy them from us. But we're going to say you're going to come integrate with our system and we're going to give you this stuff for free. In exchange for that, we want to own a piece of your company forever. So this puts them in an absolutely fantastic situation, and they've done this with tons of AI companies in the country, and they could benefit not only from companies growing and purchasing more and more usage in their cloud, in their computer processing abilities, their data storage, but just their equity positions if these companies happen to change the world. Currently, I see no better way to participate in the AI revolution than through Alibaba. You'd be investing in a high-quality company even without considering its cloud opportunities. Currently, they have over $75 billion in cash on their balance sheet and are generating $23 billion in cash flow, which I pulled from 2023. Alibaba is in a prime position to be the supplier of picks and shovels as AI and technology become increasingly integral to China. And as a cherry on top, Alibaba's reach extends beyond China, providing cloud services throughout Eastern Asia, a region with a population of over 2 billion people. This expansive market presence positions Alibaba uniquely to capitalize on the ongoing and future AI and tech boom. This is just one of the many reasons why Alibaba is the largest position in my portfolio. They have an amazing retail business that generates a crap ton of cash for them. That's the main driver of this $23 billion in cash flow, and cloud is just getting started for them. Like I said, China is generally a few years behind the US when it comes to integrating technology into their society, and they're going to start to see what has happened in the US in just the past few years. You can see just since 2019, over the past 4 or 5 years, the cloud revenue of the big three is up 500% around there. And I think that we could see the exact same thing happen in China with Alibaba being the main player. They have incredible market share, and they have amazing market share when you look at tech companies and AI language models. You see, they serve over 80% of Chinese tech companies. Well, tech companies are generally going to be the biggest users of the cloud. And you can see right now, just in the US, Amazon is the one with the largest market share here, and they have less than 50%. I think this means that we have an incredible opportunity in Alibaba to purchase them under 10 times free cash flow multiple, and they have incredible opportunities in front of them, even if you completely ignore the cloud. And hopefully this hits home for you guys and you can see why I think Alibaba in cloud is positioned so well. You can see the different data centers that they have around the world. It might be a little faded and hard for you guys to see, but you can see all over Eastern Asia, even down to Australia. They've got lots of data centers, even over into the US and a little bit in Europe, Middle East, India. They are positioned to capitalize as this part of the world really ramps up their usage of the cloud, of tech in general. This is going to be a really, really fun ride to be a part of here. I'm so excited to be a part of this company's future. If you guys want to learn more on Alibaba, check out my previous video going over more details. I've had previous one going over their earnings, a specific review of that company. So I hope this guys was helpful for you guys today. At the end of all of these, this is the end of going over Alibaba. At the end of all of these, I like to share just some news and updates on my portfolio, anything that I think is helpful and important to share with you guys. So we're going to kind of transition to that. If you guys were here for just Alibaba, thank you for being here, and I will see you in the next one. For any of you guys that want to stay, we're going to move on. I wanted to share some information that I found to be extremely helpful when I'm going through and reading Berkshire's annual shareholders letters. The first that I wanted to share was from their 1989 annual shareholders letters, where Buffett discusses different mistakes that he's made throughout his years of investing, and I pulled two in here that I wanted to share with you guys. So this first one, he says, it's a good idea to review past mistakes before committing new ones. So let's take a quick look at the last 25 years. My first mistake, of course, was buying control of Berkshire. Though I knew its business, textile manufacturing, to be unpromising, I was enticed to buy because the price looked cheap. Stock purchases of that kind have proven reasonably rewarding in my early years, though by the time Berkshire came along in 1965, I was becoming aware that this strategy was not ideal. If you buy a stock at a significantly low price, there will usually be some hiccup in the fortunes of the business that gives you a chance to unload at a decent profit. Even though the long-term performance of the business may be terrible, I call this the cigar butt approach to investing. A cigar butt found on the street that only has one puff left in it may not offer much smoke, but the bargain purchase will make that puff all profit. Unless you are a liquidator, that kind of approach to buying business is foolish. First, the original bargain price will probably not turn out to be such a steal at all. In a difficult business, no sooner is one problem resolved than another surfaces. Never is there just one cockroach in the kitchen. I wanted to share this lesson with you guys because I actually came to this conclusion just a little bit before reading this about a previous company that I have talked about and I mentioned before that I had decided to exit completely, and that was Opportune Financial. They were a financial banking loan company that was trading at a very, very low price. And I thought, why not be a part of this incredibly cheap company that maybe hasn't looked so great in the past, but could turn things around. And if they do turn things around, they would be an incredible buy. But when you look into what this company has done in the past, they have done nothing but destroy shareholder value through issuing shares and through very poor management. And anytime you're buying a company like this, you are just hoping for, like what Warren Buffett says, a hiccup at some point to unload at a profit. It is not a great way to compound capital to buy low quality businesses. And I think this is a very important lesson that hopefully I have learned. I hope I don't make that same mistake again. And I say mistake even though I actually made 50% on my money. I think in doing so, I gave myself the opportunity to learn the incorrect lesson, which I never want to do, and decided to exit it completely. So thought I would share this with you guys, as it's an important piece to understanding what company you're looking at. Next, he says, a further related lesson. Easy does it. After 25 years of buying and supervising a great variety of businesses, Charlie and I have not learned how to solve difficult business problems. What we have learned is how to avoid them. To the extent we have been successful, is because we have concentrated on identifying 1-foot hurdles that we could step over, rather than because we acquired the ability to clear 7-footers. The find may seem unfair, but in both business and investments, it is usually far more profitable to simply stick with the easy and obvious than it is to resolve the difficult. On occasion, tough problems must be tackled, as it were in the case when we started our Sunday paper in Buffalo. In other instances, a great investment opportunity occurs when a marvelous business encounters a one-time huge but solvable problem, as was the case many years back at both American Express and Geico. Overall, however, we've done better by avoiding dragons than slaying them. This is another piece tied very closely to what I talked about before. Anytime you're looking at a company, you want to make sure they are high quality, and that the reason that they are at a bargain purchase price is not because of, like he says, a dragon in their way or a 7-foot hurdle. You want to understand that this company is not only high quality in its industry, but is more than capable of easily overcoming the troubles that are currently plaguing them. You want it to be short-term problems, not long-term issues that are going to cause the company to have a slow grind down. Obviously, this is much easier said than done, but this goes into really understanding what you're investing in and making sure the company is not only high quality, but the management is extremely high quality and has the understanding and knowledge to overcome issues that they're facing, whatever that might be. And the reason I'm talking about always looking at problems they're overcoming and facing is, in my opinion, you always want to be purchasing a company at a bargain price. That's the whole goal in investing, right? Buy low, sell high. Well, when you're looking at companies that are low, usually means that there is some pessimism for one reason or another, and you want to make sure that you understand that this is a 1-foot hurdle that the company can overcome, and that allows you, just like I said, to buy low and sell high after everyone else realizes what you have, that this company is phenomenal. They have great management that was able to easily overcome the issues. No matter how big and out of proportion they get blown, if you can look beneath the surface and determine this company is going to come out of this clean and okay because of how high quality they are in their position in the market, that is a fantastic investment that you should be all over. And that's where I think Alibaba currently sits. So some very, very important business lessons that I learned from Buffett, and I'm going to continue sharing these. And every time that I go through and read these, I'm refining and adding a little bit of notes to my current process, really just hitting on things that are important and also getting the correct details that you want to pull from a company to say confidently where this company lies in the market. So this week I wanted to share as well, actually on screen, how my portfolio performed against the S&P 500. My portfolio did not do great this last week and was down about 4.57%, while the S&P 500 was up about 1.4%. I am not here for just week by week, but I like to share with you guys where things are headed. And I may change this to just monthly if you guys listening can let me know if this is helpful, if you care. If not, I'll probably change it to monthly and just share the month by month basis or even potentially quarter by quarter. But we will see. You guys let me know. Last thing that I wanted to share here was just a little bit of news on some of the companies that I currently own. This first relates to the options position that I have on TLT and the news that came out about the producer price index, where the wholesale prices unexpectedly fell 0.2% in May. They were expected for a 0.1% increase, but declined 0.2%. And this lets us know inflation is coming under control. Obviously, that was a big downside surprise and was buoyant to bonds, meaning rates came down. Just another good position. I'm coming actually very close to hitting my target of 100% returns there just over these last few months, and I might be looking to exit there. We're very close to that. Next that I wanted to share was Warner Brothers. They struck a 10-year deal to broadcast the French Open in the US. Just thought this was a little bit of important news, not critically important for Warner Brothers, but just some things that I like to see. This company is still finding ways to broaden their reach to attract more subscribers. And I think we're going to see this company really start to turn things around in the coming quarters and years, and I'm very excited for their futures. Next couple are on Boeing, the company that forever has phenomenal news. As you guys know, that is obviously not the case. But one that I wanted to share was Airbus struggles to ramp up jet deliveries even as Boeing falls behind. And this is a big part of my thesis for Boeing, is for their one only other competitor, even them that are set up to already be making planes, is having serious struggles trying to take on any more than they already are. This all to say, there's nowhere else for people to go. They have to choose Airbus or Boeing, and Airbus is saying, we can't do any more. We are at capacity. If you order a plane from us, it's coming a decade out. And that's just not going to work for everyone. So no matter how bad it looks, people have to order. They have to order planes, and it's going to come from Boeing and Airbus. And I have absolutely no fears here. This is probably one of the most confident investments that I have. It may not generate the highest returns, but I would say it is by far my highest conviction, even above Alibaba, that I would say I'm pretty confident in. This is just one that has no choice but to work unless something absolutely insane happens, and which I think in that case, we're probably not too worried about how our investments are doing. So last piece, again, companies turning to Boeing because they have no choice. A company ordering 30 Boeing 737 Maxes, a deal estimated to be worth about $2 to $2.5 billion. Again, they're going to get orders. I have no doubt in my mind. You guys shouldn't either. And this will be a great company to own for a long time that's just going to continue to move along. They're going to get things sorted out and start generating serious amounts of cash like they have in the past. So with that, guys, that's what I had to share with you. If you guys have any questions for me, any thoughts, any companies that you want me to look into, throw them down in the comments. I am happy to go through all of that, and I will try and get to every single one from the last video in the upcoming one. So with that, guys, thanks for being here, and we will see you in the next one.